I hope you're all doing well. Today I'm going to do my UK stocks I'm buying March 2024 edition. So this is where I go through all the stocks that I bought that were UK based from the 1st of February to the 1st of March. So anything I bought is always on this video series. And if I sold anything, it's always on this video series as well. There wasn't anything I sold though. There was only buys. I did buy 4 stocks during that time frame. And I've done this series for a long time now, quite a few years. So you guys could just keep all that transparency of knowing what I'm buying, what I'm selling. There's nothing hidden. There's nothing sold quietly out of the background going, oh, I hope you didn't notice that. I keep all the transparency through even the bear market so you guys can follow my journey with me investing. And yeah, hope you enjoyed it. Let's get started. And as always, if you do want to know what I'm buying and selling in real time, then the place to be is on Patreon. It's £5 a month. Join through the link in the description. There's already 500 members on there, and you get to see 2 exclusive videos a week from me. So we've just dropped the UK portfolio for March 2024. So you can see how the UK portfolio is doing. There's a Discord to talk to loads of members about stocks, including me, and you support the channel for giving all this free content out for you guys. And as well as that, if you want some free shares from Trading 212, join through the link in the description. You can get a free share worth up to £100. That's personally the broker that I use. Getting on to these stocks anyway. Number 1, Darktrace. I did buy some more Darktrace. The reason why I bought Darktrace is Palo Alto Networks brought out their earnings, which is another cybersecurity play. And it is very much similar to Darktrace, which once again is another cybersecurity company. And Palo Alto Networks brought out their earnings, and you can see here they were pretty disappointing. The stock actually dropped 26% off these earnings. And I don't know what it is with Darktrace, but there's just time periods where it just has such a strange drop. It can drop a lot of percentage for no reason, or for stocks that are similar to them, it'll have a drop in the financials, and that's exactly what happened. There was a big drop after Palo Alto Networks brought out their earnings, and I went, okay, if you're giving me, I mean, it says 5% here, I actually think it was 10% on the day. If you're giving me a 10% drop off earnings that's related to another company, I'm going to buy this dip. And it happens every so often with Darktrace, and I did buy the dip, and since then the stock is up over 10% when I actually bought. I think, like I said, I think it was a bit lower than that. So since I bought, I'm probably about 15-20% up since I did buy on that dip, which is obviously, you know, really good timing for me to buy on that dip. And I was looking at the dip caused by another business, and I was like, yeah, this company's brought out weak earnings, but should we not be focusing on Darktrace's earnings? Because they just brought out an update on the 11th of January, and they increased their revenue midpoint and increased margin expectations. I was like, the last time we heard from Darktrace, they were absolutely crushing it, so should we really punish them? So I thought that was an absolute gift, and I didn't have to wait too long to think about buying that one. Darktrace, cybersecurity company, they have 4 products: prevent, detect, respond, heal. And I think Darktrace and cybersecurity, I've always said on this channel for a good 12 months now, I think you've got to have a cybersecurity play in here for the next few years, and Darktrace is mine. Not often we get these high quality tech companies on the UK market, and then we get one like Darktrace, and I think it's massively undervalued, which is absolutely crazy. So yeah, I am taking that opportunity. But cybersecurity, massive growing area, I believe, in the next 10 years, and I think if anything, I mean, here they said that globally the CAGR is going to be 12.3% from 2023 to 2030. I think if anything, this market's going to grow faster than that. You know, you look at some of the AI situations that are going on here, I think if anything, we're just going to see increased cybersecurity attacks, you know, from this AI situation. And even now, you know, the amount of companies you see that say, oh, we've been hacked, your data's been leaked. I think it's just a fast-growing market here, and I think Darktrace has a fantastic product here from what we can see. And yeah, they brought out update this week. They brought their interim results out, and yeah, absolutely fantastic, and that's why the stock has had a fantastic week, as you can see here. So yeah, I did really well buying on that dip that Darktrace did have. Yeah, you look here, 27.4% year-over-year revenue growth. This is during a time frame as well where companies are being a bit conservative about what they're spending on, because there's that worry around a recession as well. So you imagine if we get into a better environment, what that's going to be. Increasing financial year 2024 revenue guidance and margin expansions as well. All the metrics inside the business, when you look in here, they were all going up in the right direction. I mean, you had like adjusted EBIT up 118%, adjusted EBIT up 87% as well. So yeah, really impressive, and cracking balance sheet as well on this business. There's 0 debt to equity on there. They sit on 383 million of cash. So yeah, nearly 20, just short of 20% of the market cap, which is pretty impressive. So yeah, I like Darktrace. It's not often we have a good tech company on the UK markets, and that's what it is with Darktrace. I think ultimately Darktrace will probably get bought out by someone, but hey, while it's still here at these levels and it has those dips, I will buy it. I mean, realistically, if we look at 2025 numbers, I mean, the business isn't really that crazy valued, you know, it's only still around 18 times free cash flow for a company that is going to be in a hot sector for many years, and just came off 20, what was it, what did I say, 27% growth in a weak environment as well. Yeah, pretty impressive there from my point of view. The next one is Airtel Africa. So I did buy some more shares in Airtel Africa, which has had a tough time at the moment. We'll talk about why it's having a tough time at the moment. As you can see, the stock is down a fair bit, but I did buy some more shares in Airtel Africa. We'll start with positives. Positives, I will be picking up nearly a 5% dividend yield at the moment by buying these shares. So even if the share price doesn't do anything, I'll still be collecting a decent-ish dividend yield. But Airtel Africa supplies the message, voice, data to telecoms to Africa. And there's a major growth in here, especially with data, because there's a lack of Wi-Fi infrastructure. Most people have mobile phones or getting mobile phones in Africa, and because of that, a lot of them rely for data, using their phones for messages, voice, but also internet data, which is growing massively. The adoption to 4G has just really started ramping up, and then you got to consider the 5G ramp up as well. Now, as well as having big growth in mobile phones and 4G and 5G in Africa, what also is growing massively is digital payments. So there's not a big build of digital payments in there at the moment in Africa, and the big way they're going to do that is because everyone has a mobile phone, use digital payments through mobile phones to revolutionize the payment system in Africa. And this is leading to massive growth in the digital payments at the moment in Africa. And with Airtel Africa, what you get is this big growth in 4G and 5G, but also the bigger part is this big digital payments growth that is going on in Africa. And when you look at the recent financials, they were absolutely impressive. I mean, the revenue was 20% growth. You look here, the mobile services grew 18%. And you can see here that the big thing is the mobile money growth. That was 28.5%. EBITDA was up 21%. But ultimately, why this stock is dropping is the profit was impacted by a foreign exchange win because the Nigerian currency has been devalued massively, so they have to take that as a charge when they convert it to dollars, which they report in, which is why the share price has been performing poorly, even though the financials have been doing absolutely amazing. And ultimately, I feel like, okay, there's a dip in profitability going on because the revenue, because of the charge that they have to take because of the FX conversion. If this ever was to go, I mean, you talk about a business that was doing 642 million and it will continue to grow. This company's going to be doing about $1 billion in profitability in the next few years without an FX impact, which would put them probably around 3-4 times earnings, which is insane for a company that's growing at these sort of levels. Now, the big thing, like I said, is this FX impact. And what we've seen is the weakening of the Nigerian currency, especially in the last few months, as you can see here. Now, ultimately, I've seen a lot of people sell it because of this FX impact. And that's clear when you look at the share price. A lot of people have sold going, oh, this FX impact is going to hurt the profitability. We're selling, and that's what's going on here. Now, personally for me, I'm holding this for the longer term. I'm holding it where it's going to be in 5 years. And in 5 years, I think the growth will be going up, and I think the profitability won't have that FX impact. Now, the FX impact has been absolutely painful in the last couple of months for sure, but without this political environment that we've been in, I think we'll start consolidating in the next few years. And just like how we've had previously before this big FX impact, I mean, there was some devaluation by 30-40%, but when you're a company like Airtel that's growing at these rates, you can deal with that sort of devaluation. The last time before that we've had this big impact was really around 2016, as you can see here, which wasn't even that bad. That was 61% on a US dollar to the Nigerian currency basis, which is still a lot smaller than what we're on right now. So I think this is a one-off hit at the moment that will maybe happen once again, but I think we'll start balancing out in the longer term. And then what we will start having is those longer periods of where it isn't that much of an impact. You can see here from 2019 to 2015, it was only 29%. So once this FX impact goes out, I mean, the numbers are absolutely fabulous. So it's just this bottom line that's been hit by the FX impact. And once it's out of the way, if we start talking about $1 billion in profitability, the stock looks, in my opinion, very cheap, and also from a dividend point of view, it's going to look very tasty. So I know it's a bit of a pain with the impacts at the moment, but I've got to say, for me that looks at it from a longer term, you've seen me before through 2022. I'm willing to hold stocks through pain. I'm willing to hold it through pain to get it to the other side, and I think with Airtel Africa, I think I'll get that. So when I look at the longer term, I think if we start talking about a business that does $1 billion in profitability in the next few years, it does look pretty impressive. And the third stock on this list out of 4 is JD Sports. So for Gody, I know you're asking if I was buying this one. There's your answer. I have been buying some JD Sports. So I did buy this at the start of the month. Since then it has gone on a bit of a rally, as you can see here. Last few days it has had a bit of a dip though. I think Foot Locker brought their earnings out and they were pretty rubbish. And once again, JD Sports has been impacted because of that, even though JD Sports numbers are what Foot Locker could only dream of, which is frustrating. But yeah, JD Sports, I'm sure you've seen them on the high street. Online sales, also have the the physical locations, and sell a lot of mixed brands, and they're very popular. Like, it's to the point of view where people say, what happens if Nike leaves JD? And it's really, Nike cannot afford to leave JD because they are getting so much footfall. They have a kind of a moat from that point of view. It is a very popular shop for people to go to. And also, as well as having the UK business, they've expanded into Europe, especially trying to crack the US market. And they've tried to be taking market share off Foot Locker, and they've had a lot of success from this. And they're opening up a lot of stores in the US and trying to copy the blueprint from the UK to the US. Now, if you look at the recent update, it was a slight bit of a profit warning. But even though it was a slight profit warning, it was still very impressive when you look at the valuation. Revenue growth was 6%, gross margins was in line with last year. The thing that was supposed to happen is they were supposed to increase though, which isn't bad when you look at the environment that we're in. Because if you look at the environment that we're in, you look at a lot of high-end products like Foot Locker, for example, or any other high-end retailer, and some of the numbers they're coming out, that consumer tightening of spending at the moment, a lot of people are pulling back spending, and there's a lot of businesses being hit. And what happened with JD Sports is going, yeah, we didn't improve, but we're still doing the same numbers as last year. So even in a tightening spend environment, these numbers are so impressive. If you look at the profit before tax, 915 million to 935 million. I mean, if you look at the business here right now and what it's kind of valued at, JD Sports is a 6 billion market cap business. Now, let's say they do about 600 million after tax. This is going to be about 10 times earnings. 10 times earnings for a company that is going through one of the worst consumer environments at the moment that's still growing at 10 times earnings. It's absolutely bonkers. So I think it's very good when you look at these numbers and looking at other competitors and seeing how much they've been hit, and yet they're still doing these numbers, and you're going to get it for about 10 times earnings. I mean, you look at the past performance of the business, absolutely executed to perfection. I mean, look at the growth here and the profitability. I mean, the fact that you look at the revenue from 2020, and it was 6 billion, and it's now 10 billion. It's nearly got to the point where it's doubled. And yet when you look at JD on a point of view, from a share price point of view, it's kind of like this. It's actually below where it was in 2020. So the revenue is nearly doubled, and yet the share price is below what it was in 2020. It's crazy, isn't it? And then you look at the profitability side of it. It's before the CV situation, it was doing about 250 million in profitability. You look at what the accounts are going to close at in a few weeks' time, 600 million in profitability. So the profits over doubled, nearly tripled, and yet the share price is the same price. It's absolutely crazy. Big discount to its historic valuation. Financial health wise as well, obviously, cracking balance sheet as you would expect for a company that's throwing off this profitability. You've got a little bit of a dividend there as well, that's been increased as well. And as you probably would expect, insiders are loading up and they are buying shares big time. You got the chairman of the board, for example, as well, that has just picked up 150k worth of shares. Yeah, that's all I need to know. So that's number 3. And number 4 is Barrett Development. So I did buy Barrett Development. I would not mind Barrett being a bigger position in my portfolio at all. I think when you look at the housing market, I think it's one of the guaranteed things that's going to do well in the UK in the next few years. It's having a bit of a slump at the moment because of a deal that it made with Redrow, which we'll talk about at the moment. But yeah, obviously a lot of housing companies are sunk at the moment because of the high interest rate environment and the housing market slowing down. But I think in the longer term, when you look at the demand that we need for new houses, especially now that's even been added during this period of time, it's a good sector to be in the next few years. Barrett Development's obviously a new house builder. I always think Barrett Developments look good. I mean, I'm never a big fan of new builds, but if I was to have a new build, Barrett Developments would probably be the one that I go to, because I do believe a lot of their new builds are actually pretty good looking compared to a lot of other ones. As well as that, new builds tend to have pretty horrible reputations. Out of all of them, I would dare say that Barrett Developments is probably the one with a better reputation, as you can see here on Trustpilot, for example. And like I said, you you look at the housing market in the UK, we're so short for UK houses. I think we're behind by about 100,000 a year. So if anything, once the interest rates come down, there's just going to be such demand for these houses. And the government as well has to eventually go back to supporting people buying houses, which is only good for someone like Barrett Developments. Now, interest rates is what's killing them. High interest rates go up, people can't afford the houses, that's the big issue. Obviously the big thing is when interest rates start going down, then Barrett Development's probably going to do really well again. And interest rates, I personally think we're going to see the interest rates start coming down in the next coming 3 to 4 months in the UK. We are in a recession, they need to get the economy going. Inflation's probably going to be around the 2% range this year. I think as soon as we see that first interest rate cut, boom, housing market will go back on fire. I think we're already at the bottom, to be honest with you. I think I've already seen a lot of signs at the moment saying that we're at the bottom. And if this is the bottom, the stock market's future thinking. If the market thinks that we are at the bottom, you watch Barrett Developments, it will start rolling back up massively when we do hit the bottom, or when the market does think we're there. So I don't think you've got too long to buy a lot of these house builders at the moment, and there are good opportunities when you look at some of the dips they are on a share price point of view. Now, I think Barrett got a little bit more punished recently because of its acquisition of Redrow. They did buy Redrow, and any kind of big buyout is always hated by Wall Street. Eventually they'll get their head around it, but the reason why they're buying it is because they think they can have a lot of cost efficiencies. So we'll see if that works. So I'll leave that. I think if you're going to do one of these times, it's not to buy it when everything's at 52-week highs and everything's looking rosy. I think if you're going to buy something like this, you always do it when everything's down in the dump. It's like Taylor Wimpey. They were a company that bought loads of land during the CV situation, and everyone was going, oh, why are they buying loads of land? Like, we don't know how long this is going to last for. And they look like absolutely geniuses the next 1.5 years, when everybody was having so much free cash to go buy houses, and they had all the land to build things on. So yeah, if they are going to make this acquisition, it's probably the time to do it, to be fair. But like I say, we'll probably hit the bottom now. Financially, we're probably going to start moving back in the right direction on revenue growth. Profit growth will start moving back in the right direction. I mean, a 4 billion market cap, and if we start getting back to the old levels of profitability, as you can see here, which we're sitting around 500, 600 million, I think that looks like a pretty attractive valuation, where I could see the shares going up 50 to 100% right there. Also, you got to add in the dividend yield that you'll have as well. Obviously, it's being cut at the moment, but that's probably more than likely going to go back up to 7-8% once the housing market recovers. So you're going to get a lovely dividend as well at these levels. Balance sheet wise, sits on a cracking balance sheet, not much debt on there, pretty decent cash balance as well. And from an insider point of view, there's been a couple of insiders that have been buying up a couple of shares as well. You got like the CFO that's been picking up some sort of shares as well. So yeah, there was a few as well. It's just actually gone off here. It was just over 12 months ago that were buying shares as well. So that's pretty good from that point of view. So I think I would definitely be looking at a house builder in the portfolio if you aren't already. Just like a cybersecurity stock, I think they are the key areas that will do very well in the next 5 years. And Barrett's my pick anyway. So yeah, that's the UK stocks I'm buying, guys. 4 stocks there for you guys. As always, let me know what you're buying in the comment section. Apart from that, have a cracking weekend, and I'll see you probably again on Monday. Unless you're on the Patreon, I'll see you on the Patreon. So thanks for watching, guys. See you in a bit.